What do Hewlett-Packard, Oracle, Tesla, Toyota, and Charles Schwab have in common? We'll discuss tonight on Open Interest. According to Stanford University's Hoover Institution, nearly 300 companies have moved their headquarters out of California since 2018. That California is ranked 49th, second to last place above only New Jersey by the Tax Foundation's State Business Tax Climate Index is certainly one of the reasons. That well-known tech companies Hewlett-Packard, Oracle, and Tesla have relocated to Texas may be less surprising than the fact that integrated oil company Chevron has remained. The company's roots in the state actually date back to the 1800s, and their San Ramon headquarters, less than 50 miles from where I'm currently sitting, at least for now anyway, is going to be vacated quite soon. The company announced they're going to be leaving their Chevron Park campus, and they're going to cover the moving costs for employees who voluntarily opt to move to Houston, where the company has been growing. In fact, the Houston office already employs 6,000 people. That's 3 times as many as are employed at the HQ here in San Ramon. And the company intends to vacate that campus by late 2023. Options traders are probably more interested in where oil prices will move than Chevron employees. We saw a substantial call purchase. The August 175 calls traded. The buyer of those calls is betting that Chevron could retest the year's highs within the next 2 months. So Friday, June 17th, the S&P index hit an intraday low of 36.86.87. And today we saw it hit an intraday high of 39.45.86. And of course, we saw it sell off considerably since then. That gain represented 8.5% in essentially 6 trading sessions net of last week, which was a holiday shortened week. And impressive as that was, much of today's flows actually represented some of the more persistent themes that we've been seeing over the course of the last several months. Number one, that Chinese stocks are bottoming and that the economy is continuing to weaken and bonds may still have further downside. HYG, the high-yield bond ETF, already hard hit by rising rates and fears of a recession, saw a 30,000-lot September 72.67 put spread trade. The buyer of that spread is targeting another 9% to the downside by September expiration. And although Chinese internet ETF KWEB didn't finish higher today, the 54 basis point decline significantly outperformed U.S. equities. One option trader believes China stocks have bottomed and expects significant further upside, buying 30,000 out of the money 39.41 call spreads. And finally, we saw an interesting trade in the January 2024 5-strike puts in steelmaker Cleveland-Cliffs. CLF is currently trading at less than 2.2 times trailing 12-month earnings, and about 4.3 times the $3.72 a share the company is expected to make next year. This is a dynamic one often sees in cyclical names prior to economic downturns. Companies will look exceptionally cheap with the lens of recent profits, as investors are actually looking ahead to potentially leaner times. In any case, I'm not convinced that the buyer of these puts is actually believing that Cliffs is going to drop 70%. I think rather this could be a hedge. Even the relatively short-dated bonds, they have some maturing in June of 2027, are yielding more than 7.3% at current prices. And it's possible that somebody is hedging some fixed income exposure with those long-dated, out-of-the-money puts. That's all I have for today. Please like, comment, and subscribe, and I will see you in the next one.